in terms of similar economic characteristics of the right of use assets. But if you're presenting within PPE, then, for example, right of use assets, vehicles, right of use assets, other equipment would be separated, disclosed separately. And of course, the standard disclosure requirements applicable to property, plant, equipment for the depreciation, opening balance, carrying value, and closing balance would continue to apply in this case as well. In terms of the lease liabilities, the amounts distinguished still have to be distinguished between amounts that are due within 1 year and those that are due after 1 year. And once again, the option remains to present the lease liabilities within a line items for other liabilities or separate from other liabilities. And again, just to show you a quick illustration of this, in the liabilities and shareholders' equity section in the current liabilities, you see the current portion of lease liabilities separately disclosed here, and the current non-current classification appropriately done. By contrast, you can also have current portion of the long-term debt combined with the current portion of lease liabilities, and similarly in the non-current portion, combining other long-term debt and lease liabilities together, so that both these presentation approaches are permissible under the standards. I talked earlier about the amortization of the right of use asset, right? Now this charge has to flow through to the P&L under the amortization route. The allocation, again based on the principles outlined in our own Companies Act in the relevant disclosure schedules for applicable to public listed companies as well as private companies, you can present this amortization by either by nature or by function. What do I mean by that? By nature means, by function, sorry, means with respect to the relevant category of expense. And by nature means, for example, if it's to do with cost of sales or administrative expenses, or it's to do with selling and distribution. So by nature of the asset where it resides, or where it is used rather, the classification can be grouped in that category. Wherever the amortization of right of use assets is presented in the P&L, the interest costs must still flow through to finance cost line. That's a requirement of IS1 as well as the presentation requirements under this standard. So coming to the statement of cash flows, if we look at the profit for the period, which is the opening line item for the reconciliation of the cash flow from operating activities, that already has deductions that have flowed through which relate to the lease payments for the interest component if you have opted for the operating activity classification, as well as any payment for short-term leases as well as leases of low-value items. This all has already come through as an expense under this line item. In your financing activities, essentially it will reflect the principal repayment of any liabilities, as well as if you consider if the entity's accounting policy choice is to have interest expense as a financing activity, then that line item will go through this here as well. In terms of specific qualitative disclosure requirements from a lessee's perspective, there are certainly some increased disclosure requirements. Some of these are listed out here for you. Of note are information about sale and leaseback transactions, leases not yet commenced to which the lessees may be committed, as well as any potential cash flow that an entity may be exposed to because of variable conditions. So that's the presentation disclosure requirement for lessees. Not very complicated. From a lessor's perspective, it's even less complicated because not much has changed actually. Substantially, the accounting and recognition requirements remain similar to the IS 17 requirements. To give you an overview of the disclosure requirements, for finance and operating lease, if you take a look here, from a finance lease perspective, an increased disclosure requirements from a quantitative side relates to the quantitative and qualitative explanation of changes in the net investment, as well as the maturity analysis of the lease payments receivable. From an operating lease perspective, again, the disclosure requirements are largely similar to what you have seen under the old previous regime. From a qualitative disclosure requirement perspective, the increased disclosure is primarily with respect to risk management guidelines and an entity's disclosure about how the risks are managed on the underlying assets. And these include risk management strategies relating to buyback agreements, residual value guarantees, variable lease payments for excess use. So for example, in many countries, for example, auto leases, if you have used the vehicle more than a certain mileage, there's an excess use component. So that's what's meant by the excess use aspect here, and any other risk management strategies. So for financial institutions and other entities, large corporates who have larger impacts from a lessor point of view, they will likely need to engage with their treasury teams to help assist in drafting disclosure requirements for these areas. And what's important to note is that the disclosure requirements will of course vary by the industry. Hina talked earlier about the aviation industry being significantly impacted. From a Pakistan perspective, I see the retail industry as well as the financial services sector, other entities, other sectors being significantly impacted as well. And therefore the disclosure requirements will tend to vary from one sector to the other. I think you will start seeing a lot of sample illustrative disclosures out of and available. All the large accounting firms will have model financial statements, so there will be a lot of resource available for assistance here for you. And please feel free to reach out to any one of us presenters here today if you need any help. That's it from a presentation disclosure point of view. I'll pass it back on.
Thank you, Zulfikar. That was really quick. Now we have two things happening. We'll have the session, we'll have the panel actually in the end. Just now we'll actually have the Iasb update. And along with that, since we're short of time and I can see that everybody would be still yearning for that cup of tea, we have running tea arrangements. So you can always go out and grab a cup of tea and bring it in with you so that you don't miss the session, because we won't be actually taking a tea break. So we will begin with the ISB update by Mr. Chung Woo So, the ISB board member.
Hello, Pakistan. Assalamu alaikum. Thank you very much. Bohat shukriya for inviting me to your conference. Today, I'm going to present the IASB technical update. I'm Chung Woo So, a board member. I'm working for the International Accounting Standards Board in London. So now I'm going to make a presentation on our ISB technical update. Generally, there are 2019 amendments and consultations, and our maintenance projects, our completed projects, and we have many active projects. So I'm going to focus more on our active projects because you have a opportunity to give your valuable advice to us. Okay, the first topic I'd like to update is the amendments expected this year. So there are two main amendments that are expected in 2019. One of them is classification of liabilities as current or non-current liabilities. The board expects to issue their amendment in 2019. That's the amendment to IAS 1. Another amendment we are expecting this year is IBOR reform and its effects on financial reporting. The board expects to issue the exposure draft and final amendments in 2019. Because we are going to issue an exposure draft first, you have a good opportunity to give your advice to us on this IBOR reform. There are also other consultation documents. The IASB expects to issue the following consultation documents. In the first half 2019, primary financial statements, rate-regulated activities, goodwill and impairment, and 2019 comprehensive review of the IFRS for SMEs standard. And the next year, first year of next year, the first half of next year, we are going to issue management commentary and the business combination under common control. I have to make a correction. The first 4 consultation documents will be issued in the second half this year. Sorry about that. We have small maintenance projects. Basically, they are issues raised from our interpretation committees. Basically, all our stakeholders in the world can make submissions to the interpretation committee if you have any issues with the application of our standard IFRS. So based on such maintenance issues, we have already issued an exposure draft on the onerous contracts. What is the cost of fulfilling a contract? That comment period is 15th this April. So if you have any comments on this project, you can send me on your advice to the ISB for this exposure draft. There are still many exposure drafts this year. For example, amendment to IFRS 17, insurance contracts, deferred tax-related assets and liabilities arising from a single transaction, disclosure initiative, or especially on accounting policies, updating a reference to the conceptual framework, and annual improvements for 2018 and 2020. This year, we have completed 3 projects, so we are going to issue project summaries on following 3 topics. One is discount rates, another one is improvement to IFRS 8 operating segments, finally disclosure initiative on principles of disclosures. We have plenty of active projects. Those works in process now. Basically, I'm going to explain some of these active projects in more details from now on. Basically, more than almost about 10 active projects. They are very important. So in the beginning, business combination under common control and disclosure initiative, we are targeting standards, some standards, and we are focusing on their disclosures of some specific standards, whether we could get some ideas how to improve disclosure. So that will be the second active project. And extractive activities, goodwill and impairment, management commentary, pension benefits, and that depend on asset returns, primary financial statements, provisions, rate-regulated activities. dynamic risk management, so-called DRM, financial instruments with characteristics of equity, and finally, interbank offered rate, IBOR, and the effects on financial reporting. The last one is I already have explained it to you just a minute ago. Among these active projects, the first active project I would like to explain to you is business combinations under common control. This BCUCC are excluded from the scope of IFRS 3 business combinations because there are no specific IFRS on business combinations under common control. In practice, companies are using diverse of accounting methods. So that's why we are going to tackle with that diversity with a new standard on business combinations under common control. Basically, the issue with these business combinations under common control is their measurement issue. Whether we use the acquisition method that's set out in IFRS 3, basically that's a fair value method. Another one is predecessor method, basically it's a kind of book amount method. Anyway, these two methods are being used in practice. So there is a kind of a loss of comparability and some kind of a problem with the relevance. That's why we are going to develop a new standard that will get some kind of comparability among entities. So basically, we are considering on this decision process, we are trying to use a single method for all transactions within the scope. So we have to decide which method we are going to use as a single method. However, if there is some necessity to use a different method from that single method, then we have to decide which method we'll use as a different method and how to choose that different method for another kind of a different type of business combinations under common control. As I explained just before on the previous slide, there are basically two methods. One is acquisition method, another is predecessor method. If there are other methods you have in your mind